lecture, we're going to cover a little bit more about revenue and revenue models and some of the questions you're going to be asking as you try and come up with where your company is going to be going for revenue. You might have started that last week, but that was just a very brief introduction. We'll get a little more detail today. So let's start. What is revenue? Revenue is the income gained from sales of your goods or products. It's actually very simple. If you have one product, it's number of sales of that product times the price people paid for that. If you have multiple products, then it's a more complicated formula. Price of product one times sales of product one plus price of product or service two times sales of product two. Or computing it is pretty straightforward. Projecting it is hard because you have to guess what your sales will be, but it's actually pretty straightforward to talk about what a revenue model is. But the most important part is that this revenue model is a key component of your business model, identifies how the company will earn income and eventually therefore make profits. Right? There's going to be lots of different ways you can do it. But before we get into the revenue model, some of the most important questions are to ask, what do the customers think about revenue and sales and prices and whatever? So most important question is, how much are customers willing to pay? So as you do your customer interviews this week, you might be asking that kind of question. We'll come back to that in a little bit. But once you have some idea, let's say customers willing to pay $30 for your product, you can then start asking the questions, how many customers do you need to get to make your company or your business viable? And that's solving a simple equation. If you know how much money you need and you know how much they're willing to pay, if you can estimate how much it costs, then you know how much money you make per product to cover what's called we'll come back to that in a little bit with the gross income, and then you need to put stuff on top for all the other operations. So you can answer, and we'll try and get to how to answer that question. Actually, very important for a company is how much cash can be generated through these sales. And for a real fully operational business, I'd want you to do a real cash flow analysis, because if you run out of cash, you can't pay people, bad things happen to your company. Generally, it closes. And you can have a company that's actually doing okay at sales, but the money's not coming in fast enough. In my second company, the lead time to close a sale was around 6 months. And after we closed it, until when we finally got paid, was somewhere between 9 and 18 months, because the customers had to actually get money to pay us, and so it was like often into the next year's budget cycle before they could pay us, and sometimes they'd pay us a small amount up front, but then the full payments were very long. So that makes it very hard, because your company has to have enough cash on hand to keep paying the bills for a long period of time. So cash flow and what customers will pay can actually be different, because they might be willing to pay, but you might not get it for 30 days, 60 days, 90 days, or maybe even a year. And then when you're strategizing for your company, you want to think about how much each revenue stream contributes to the total, especially if you're looking at a multi-sided market where you might have some customers that are costing you but not producing revenue, and other customers who are producing revenue, or multiple customers. How much do each of those contribute to the total, and how do you want to balance that out? As I mentioned last week, there are really multiple types of revenue models: just unit sales, advertising, selling your data, intermediation, licensing, franchising, subscription, professional services, utility usage, and freemium. So these are all things I talked a little bit more about last week. By now, if you haven't, you should be thinking about, how is our venture, which of these 10 models, or which combination of these 10 models will my company be using as you try and move forward? Because you want to test the hypothesis that that model is going to be acceptable to your customers. So when we think about what drives revenue, there's really four major things: the price at which you sell something, the number of customers to which you sell, the frequency with which those customers actually all go into buying, and then there's also the selling process. For some revenue, you actually can view it as, how many salespeople do I have? So if I wanted to build a bottom-up model for how I actually generate revenue, I might say that each salesperson can make 40 calls per day, and of those, one or two of those will turn into a sale, and then I can take the sale. Let's say the customers then buy on a regular basis, so I can have a frequency and a price. So the selling process is often a key model for how to drive revenue. You don't want to say, I'm going to assume we can sell to 10% of the market. No investor will view that credibly. It's not a good business plan model to assume that you can go from 0 to 10% instantly. The right model is to assume you understand something about your selling process. We're going to contact this many people. This fraction of those will then be interested in buying, and they'll move forward. And then you can take an account of how much effort it takes to get there. Through your customer interviews, if you interviewed 10 customers and one showed an interest, then you might be estimating that 10% of the customers you contact might be interested. Now, it's a pretty weak number if you only have 10. If you interviewed 100 and 10 out of that 100, then you'd have a pretty good idea that was really 10%. So the scaling up model is very important. You don't want to just make up numbers because then your business is likely to fail because you've made assumptions you haven't validated. Try and validate that selling process, the frequency of total customers, and then you can work through the rest of it. With respect to costs, costs really have the biggest part for most people for a product is the cost of goods sold, which is the value of the goods when a sale takes place. So if I'm making a widget, in fact, let's do a simpler one. I'm buying a widget from Alibaba and then I'm reselling it. Viable businesses do this all the time. So the cost of goods sold for you then is what it takes to get it bought from Alibaba and delivered. So we call that the landed cost. You want to have the total landed cost so that you can then start shipping them out. In addition to the cost of goods sold, that's the cost for the actual product, you have other operating expenses, which is the administrative people in your company, marketing, research, salaries. My recommendation, what I'm going to require when you do your financial business classes, you should always be including your salaries in this. And we'll come back to that when we do more detailed financial projections later. But when you're thinking about it, you can't say, I'm going to work for free forever. Now, for the first year, in fact, in my last company, for the first 5 years, I worked strictly for equity. I did not get paid during those 5 years, but that's okay. I was allowed to defer it. But on the books of the company, from an accounting point of view, I was accruing money the company owed me. They just weren't paying it then. They paid it later, which was good for the company and okay for me. So you should be figuring out what it is to make the company profitable with all of your salaries in there. And then you can figure out where, if you want to choose to reinvest your salary as an investment in your own company, that's perfectly fine. So cost of goods are the things directly tied to the product. It gets to be a little tricky when you're doing your accounting. For example, if I have to ship a product, is that cost of goods sold or operating expenses? And part of that will depend on how it's actually accounted for in your system. In my company, if we had to ship a product, that was included in our cost of goods sold because that affected how we could bill the government with respect to things, as opposed to overhead expenses. So other places will put shipping and marketing, shipping down with the operating expenses. You can go either way. So when you think about a retail operating expense, so you have a store or whatever, you have the additional costs of rent, utilities, those go in. There's other accounting things that matter like insurance, transportation, taxes, legal fees, benefits. Benefits can actually be very large if you're paying benefits for your salary, so I lump that in with salaries. But depending on the company you're in, insurance can be either really inexpensive or expensive. The single most expensive thing for the nonprofit I run in terms of operating expenses is insurance. Because we run events, and for every event we have to be buying insurance. We have a bunch of board of advisors and the board members who want to have insurance to make sure that if we do something wrong, we're not personally liable. Our operating expenses for an event, right? We have the income and outgo for that expense. That's of course big, but the day-to-day operating expenses, insurance is by far our biggest piece. So, and we pay, I don't know, $7,000 a year, $8,000 a year insurance. It's not trivial amount for our organization. So when we work in this class, we're going to go for rough orders of magnitude of these things. We'll point out, depending on what your business is, or you should figure out if your business cares about rent or utilities or insurance, and it's not that hard to figure it out and then estimate what those numbers might be. So when you're looking at an overall thing, we're not going to go into details. We'll actually, if we have time later in the semester, we'll come back and do it in much more detail. But an income statement is one of the three primary financial statements for a company. We can talk about the income statements, the balance sheet, and the P&L, or the profit and loss statement. And we'll come back to P&L and balance sheets later. But for now, an income statement is a very gross income statement is what you need to be thinking about to make sure your business is viable. An income statement is a financial report that measures the financial performance of your business on a monthly or annual basis. In fact, my recommendation is when you're doing a startup, your first year should all be monthly estimates rolled into an annual. Second year should be monthly rolled into an annual, and then after that it can be annuals. And then when you're reporting after the fact, there's data in those monthly, so you want to keep them, but you also look at it from an annual statement. The book says that an income statement is also called a profit and loss statement. To me, they're actually two different things. We will talk in more detail about those fine details later, but for now, we'll call them income statements or P&L statements. Right? What you really need to do is make sure you understand how your company's working. Another very important one, which is separate, is a cash flow statement, because that affects when payments come in. It's more detailed than we'll need to go into in this class. But if you ever do decide to move forward with your venture, you're going to want to dig a little bit deeper into that and learn about cash accounting, assuming you have cash for your company. And the basic idea of this is you're going to subtract the cost of goods and expenses, and it leads to a bunch of very standard terms. So as I already mentioned, revenues is really number of sales times price per sale. That gives you a total revenue number. Cost of goods is similar. We have a cost per product times the number of products, although for many costs of goods, they don't scale as nicely. If I buy 1,000 products from China, I might be paying $5 a product, but if I buy 2,000, I might be paying $2.90. So you have to think about what they're going to be and the cost of goods for a total amount. And revenue minus cost of goods sold is your gross profit. And people will often talk about your gross margin, your gross profit. Your gross margin would be, in this case, I had $100,000 and $200,000 in sales, so my gross margin would be 50%. After that, I can talk about the operation of my company. So I have the salaries for general, sales, administrative, marketing, research, appreciation and amortization. That's a small number for now. If you have a big capital company with lots of equipment, it's important, but it's an accounting thing about how much you get to write off for equipment or whatever. So this gives us an operating profit of 41. If we're paying things like interest and expenses, then this gives us a total net income of $31,000 out of $200,000 in sales. So that gives us our net profit margin. Your operating expenses and these other things, again, these are all estimates. This is just to sort of give you a feel for what matters. And it gives you an idea that there's going to be expenses for these things. And depending on your company, marketing could be small, like $5,000, or marketing could be huge because it's a big part of getting customers, and you have to see where that's going to go. The biggest issues are to make sure that after a certain point in time, this net income becomes a positive number. If it's negative, that means you need investment to survive, and you're going to have to get at least that much money. Now, if you've put in your salary as part of the sales administrative salary, which you should, then the net income, you can always look at your investment and say, well, for the first year, I'm not going to take salary, and then come up with a net income after investment. There's a bunch of terms used in the field for this. So there's things like EBITDA, earnings before profit, depreciation, taxes, and income, which should be at this net operating profit line. And then there's net profit at the end. So where do you begin to do this? Sorry, now we're moving on to pricing because you need to have this. So where do you begin for pricing? So by far the first example you need to consider is what's your competition and how do they handle pricing? Now remember, competition doesn't mean somebody who does what you do. Competition means somebody who has a product that helps solve the customer's problem or partially does the job your customers want done. So if you're selling laptop computers, some of your competition, depending on what you're trying to sell them for, would be desktop computers because it's only the mobility people that need it. So it depends on what your market is. At the other end, if you're trying to sell tablet computers, you might also be competing with a notebook because if you're trying to say, well, this is great because you can write on it and take notes in class, well, I can write on a piece of paper and take notes in class. So there's a wide range of pricing and competition. You have to be careful. So you want to find both close competition and substitute competition and figure out where that is. You can ask questions of other people in the industry. They're charging prices. This is usually useful when you're trying to price a product that is very different from anything else. And while there is competition, it's hard to say how that competition relates because what people will pay for a tablet isn't the same as what they'll pay for a notebook, even though it has some of the same functionality, it has a bunch of others. So now you have to find some mixing, and so finding some advice in the industry can be helpful. By far, in my view, the best thing is ask potential customers how much they would pay or have paid in the past to solve their problem, not necessarily just your product, but it may be even to solve your product. And the reason we'll come back to that, that's the most important one, and we'll come back to that in a little bit. So the book talks about 8 primary pricing strategies. Competition-led pricing. How do I price so that I'm at my competition, I'm above my competition, or below it? Now you might all be, because you're all students, many of you may be thinking, well, I want to have a lower price than my competitors. Lower pricing than your competitors is generally only a sustainable business if you have a way of delivering that value for cheaper. So if you want to compete with Walmart on price, you're doomed. Walmart has a huge infrastructure and great logistics to get products at a price, and they have great negotiating power because they buy so much. If you want to compete with a local coffee shop, say Starbucks for price, you probably can until you start to grow. So you can have a small business that might compete with them on price, but if you actually wanted to grow, Starbucks could cut the price of their coffee. Starbucks isn't pricing their coffee based on what does it cost to make. They're basing it on what they can get away with. So big companies can drop their prices very quickly. So it's very dangerous for your primary value proposition to be, I am cheaper. If you want to sell computers, it's hard to beat Dell's pricing for computers in large scale bulk. You can beat it on bits and pieces here and there. You have to figure out how you're going to sustain that price advantage if you go down that. Related to competitor-led pricing, and one of the times when you can, is actually two other ideas called a loss leader and introductory offer. In a loss leader, I actually sell multiple products, and I sell one product potentially even at a loss for less than it costs me, which means I can be very cost competitive, but I sort of know I'm going to bring people in. And so if I bring those people in, and in a grocery store, they often have sales. The whole reason sales work for a grocery store is they get people to choose to go to King Soopers over Albertsons because of this week's sale, but you don't buy just the sales items. You buy all your food generally when you're shopping, and so it's a good deal. Similar introductory offers, you've probably all seen these for things like internet and whatever. They try and get you in with what sounds like a low price, and it's good for a short period of time, and they're counting on the fact that once you're a customer, you're not going to easily leave. So in both those cases, competition-led pricing is actually important, and it can be a sustainable way because you're going to make money either by their continuing on or by selling them other products. Customer-led pricing, I'll come back to it at the end. It's actually, it might be the most important. Skimming is a kind of pricing strategy where you really say, I'm going to mark up my product a fixed amount, and I'm just going to pass along. It's pretty straightforward to basically take a piece of every transaction. So skimming is most common not in product sales, but in service or transactionally oriented things where when I'm doing a credit card transaction, I'm taking a 5 or 25-cent charge of the thing, right? And it's a fixed amount of fee, and it's really based on how much you can get away with. So it's a little bit like customer-led pricing, but it's actually done inside a transaction, so the customers are often not even aware that it's happening. Psychological pricing, this refers to a strategy where you've all seen prices that, for example, end in .99 or .95. And different studies have shown that people think that a product is a better deal when it's $12.99 than when it's $13, because the leading digits drive some of their psyche. So that's a very small tactic. It's not a general pricing tactic. It affects a little bit what you're going to do. Another process often used when you have a very unique product, a monopoly, is fair pricing, and I'll come back to that in a little bit more detail. Bundle pricing is the one we're talking about next, so we'll come back and spend more detail on fair and customer-led. So bundle pricing, you've all seen it. This is where you're going to buy your combo meal. You get a sandwich, a soda, and fries. You get a sandwich, soda, and fries at less than if you bought each of them individually, but the difference is still enough that they're making a profit on each of the added items sold. So in general, in a food store like that, your margins might be 50%. So when I add, and it depends on the item, 50% might be good for a sandwich, but on a soda, I'm probably making 80 or 90% because they're very cheap to make, and they're selling them to you for $1. A soda out of a fountain with a cup, by far the most expensive piece is the cup, followed by the service to hand it to you, followed by the actual soda itself. So it doesn't make a big difference. So the bundling of prices gets you to think you're getting a good deal and often gets you to buy stuff you would not have otherwise bought. So if it's a great offer and it's 20% less than the meal would have made, but they make 30%, so they make 50% margin on average, then they're still making 30% on the extra items they sold you that they might not have sold you anyhow. So the real question in terms of long-term pricing strategies, if they would have bought them anyhow, then you lost money compared to what you might have if you sold them separately, but then you have to study how many people buy the combo because of the convenience and whatever. Cost-led pricing is another one that's talked about in the book. This is where you basically base your price on all the costs of the product with an added expected profit. So if it costs me $1 to make and I sell it for $1.25, I've added 25% for my profit. And depending on what you're doing, that might be okay. My view is it's good to know this cost-led pricing because this is what I would consider a lower limit for your pricing. If you can't get your customers to pay this price, you're probably not in a viable business. But you do have to remember that cost may decrease as you scale. So while it costs you $1 to make it now, in volume, it might be down to 50 cents or 30 cents, depending on where you reach in volume. So maybe in the future, you can make a lot more money at it. And now you just got to prove the market. It's okay to actually do that. In fact, in the beginning, cost-led pricing is a bad strategy sometimes because you have to acquire customers. And if you try and price in everything at the beginning and you don't have scale, then your costs are too high. So even if you do cost-led pricing, you want to use future costs based on some level of scale where you think you can get, and that's why you start with some investment dollars. Again, cost-led pricing is not what you would probably want to use for any of the things you're going to do in this class, but it sets a lower bound of what you probably want to aim for. Target return pricing is similar. It's based, now the price is based on the amount of investment, and I would consider this a common plan pricing. So I'm doing business plans, or people talking about business plans. This is often what they say, how they determine their price. And it's really to show the investors there will be a return. So if I want to have a 50% return for my investors, then I might use this and say, here's my pricing, here's my sales I'm going to be. It might be okay to get for a minimum to get an investment, but you have to be very careful on having validated this. And so in my view, either you haven't validated it, or you validated it and you probably could have got more money out of the table, because then it would have been based on the value. So this is really how I recommend you look at trying to do value-based do pricing, is you base it on how it benefits the customers and what customers are willing to pay. This is the best model, but you need to have it in such a way that you can have, remember that different customers have different values. Hence, it's still a balancing act. If you have some customers who are willing to pay a lot and others who are willing to pay a little, you have to decide which of those customer segments, because they're not the same. If one customer will pay $10 and one will pay $100, you have not done a good job of recognizing your two different customer segments. In that case, one of them must have a greater pain point or see greater gains from the product than the other, because they're going to pay a lot more for it. So then you probably want to resegment your customers and think about how to reach them and where you want to be. And then what's the balance? How many $100 versions do I want to sell versus $10? If I sell it for $50, I might not get any of the $10 people, but I might get all of the $100 people, and I might get a few more. So how many few mores are worth it versus how many I lose? And that depends on analysis from your data. You may also want to balance this with what is fair. This comes back to the fair value pricing, or fair pricing. And some of you may remember in the last couple of years in the news, there was this EpiPen product, which is for people who have anaphylactic shock or other things for which epinephrine is important. The EpiPen is a lifesaver. And if you're in that category, you absolutely want one of these pens in your pocket at all times, because it's the difference between dying and not. And at that level, you will pay a lot for it. And there's a patent for this process, and there was a company that was selling them, and the company was actually acquired, and the new owner said, well, we have a monopoly on this. We're going to go from charging $100 a pen to $500 a pen. And there was a lot of customer blowback, literally to the point where Congress got involved and started, are they abusing their pricing and whatever. It's bad press for a company. It's bad for you if people think the price isn't fair. In this class, none of you are likely to have something with such a monopoly that you can charge an unfair price. But this is actually the important part about value-based pricing. If it really is that valuable, and in fact, if the EpiPen had not been previously sold at a lower price, people might not have said that's an unfair price. It was the raising of it for no good reason that really made people angry. But value-based pricing is how much value are adding to the customer. If you're saving their life, maybe it is worth $500 to them. And that's a broader business question to figure out what's fair. Okay. Value-based pricing, though, isn't quite asking your customers, would you pay $1 for this? In fact, what you want to ask them is how much they would pay to solve their problem. How much have they paid for related products? Don't ask them a price and get them to say yes or no, because that's not a very good place to be. If you ask too low, then they're going to say yes, and you won't know how much they would have paid. If you ask too high, they might say no, but again, you still won't know what they would have paid. Your whole point during interviews is to learn, and so the best way to learn about pricing is to ask them what they may or may not be willing to pay for a similar product or for this product. It's easier to ask them a particular price, but it just doesn't provide near as much information. So this is some high-level basics on value and pricing, so that when you start working through your customer interviews, you can begin thinking about how you would incorporate that into your business model.